Hey guys, this is Casey here with howtoplaystock.com. Today is June 23rd, 2017. Hope you guys are having a good Friday. In today's video, before I get started, I just want to say to my subscribers, thanks for tuning in and watching. I love you guys, and some of you guys, some of the comments I get from you guys and feedback that I get from you guys is just wonderful. So I want to thank you for that. And for the new subscribers who are jumping on the channel, I just want to briefly tell you that this channel is about investing in stocks, and not just stocks, but some other opportunities outside of the stock market as well, because as an investor you want to look for opportunities where they present themselves, okay? And sometimes that is outside the stock market. So this channel has evolved a little bit. Just recently I've been talking about cryptocurrencies a little bit more because the opportunities there and the returns that people are getting are just astonishing. So that's what this channel is about. I cover multiple topics on investing, everything from dividends to dividend metrics, PE ratios. I'll cover individual company stocks from time to time, but the main majority of my focus when it comes to investing in stocks for you new subscribers is that it's all about getting a plan together, having a strategy, and then trying not to lose your money, okay? So if you're new, you can go back and watch some of my playlists that I have, but I would highly recommend, instead of doing that, just to save you some time, go into my description of this video here. You can click on my investor's guide, the e-course that I have, that I put together, and it's just basically all the videos that I've been covering for the last 1.5 to 2 years packaged into just a 2-hour e-course. And so I try to condense everything and all the knowledge that I have on investing for you to make it easier. So if you haven't checked that out, I'd highly recommend checking that out. There's no cost for it. It's completely free, so you're not out any money from this. And if you're wondering why I'm helping people, it's because I've been investing in the stock market for over 4 years now. I had 4 years of research before I even put my money on the table, and I can tell you I've lost quite a bit of money, but I've also made quite a bit of money as well. And along that journey, because that's what it is, it's a journey, you start learning some things and you start learning what not to do. And I didn't really have anybody by my side to teach me these things before I even got started. So I just want to help people not make the same mistakes that I've made, because it's really easy to make the same mistakes that I've already made. And I would not, I don't like seeing people lose money because they don't know what they're doing. So that's what my channel's about. Again, for my subscribers, my new ones, check out that e-course guide that I have. That will lay out a solid plan for you. It'll basically let you know like what game you're playing here when it comes to the stock market, because it's a casino. I mean, that's really what it is. It's the wealthy man's casino. So with that said, let's get into today's video. I want to cover the indicators on the stock market and things that you can look at to kind of give you a picture of where we're headed, okay? Now these indicators I've covered in multiple videos. Again, like I said, a lot of them go back to 2016. So the first one I want to talk about though is overvaluations, okay? With the stock market being overvalued or undervalued. How do you determine that? It's pretty simple. Just look at the PE ratios, like on the S&P 500 or the Dow Jones. Anything between, let's say, 10 and under is undervalued, okay? PE ratios between 10 and 14 are usually considered fair value, and anything from 14 on up to 20 and over that is extremely overvalued, okay? Now, PE ratios with the major indexes like the Dow Jones and the S&P 500, when you're looking at those and you're just seeing this number, well, what does that mean? Okay, what is, if you look at the S&P 500 right now, I believe it's like somewhere around like 27 on the PE ratio. What does that number actually mean? Well, the average employee, okay, so right now the S&P 500, I believe the PE ratio is around like 27. What that means is that the average employee can't afford the Dow Jones, okay? And the Dow Jones, I believe, is probably right around there somewhere too. I'm not looking at it, so if I'm wrong on that, go ahead and correct me and leave it in the comments section. But the average employee can't afford the Dow Jones right now. Okay? What that means is it takes about 27.51 weeks of income to afford the Dow Jones for the average employee. All right, now just to give you an example here, I've got some notes that I wrote on this, so I want to make sure I get it right. But just to give you an example, in 1980, the Dow Jones during the bull market, it only took 2.93 weeks of income for the average employee to afford the Dow Jones. All right, so you got, right now we're at 27.51 weeks of income. Back in 1980, it was 2.9, what did I say it was? 2.93 weeks. So which would you rather, which rather would you rather do? Would you rather spend 2.93 weeks of income to afford the Dow Jones in 1980? Or would you rather go with 27.51 weeks of income to afford the Dow Jones? So that it's extremely overvalued. That's what I'm trying to say here, guys. And that's an indicator to look at. Okay. Again, when you're investing in stocks, Jim Rogers, if you don't know who he is, go back and check him out. Do a little research on him. He's one of the world's greatest investors out there. But he says it's about the price that you pay when you're investing in anything, any asset. So always look at the price that you pay. Are you willing to pay that kind of price right now? And that's the question you need to ask yourself if you want to get into stocks at this very moment. The next indicator I want to talk about is the federal funds rate. Okay, right now, for the last almost 10 years, we've been at damn near 0%. Okay, that's the longest in the history of mankind for any country to keep interest rates that low. All right, so that's an eye-opener, because what does that tell you? Anytime you get interest rates lowered, okay, to 0 or 3% or whatever, when they lower the interest rates, what they're trying to do is kickstart the economy, because interest rates are lower, people can borrow money and they can pay that back with lower interest. So it's supposed to spark interest in business owners to go, bring on new loans so they can expand their business or start a new business. That's what it's meant for. Now, right now we're at 0.75 to 1%. I believe right now, I think we're at 1% because Janet Yellen just raised the federal interest rate by 25 basis points. Nothing big, okay? They can't really go above the 0.75 or 1% in interest right now, because you have a national deficit of over $20 trillion or close to it. If you do the math on that, I believe right now from David Stockman, who is Ronald Reagan's former advisor, he has said specifically that the interest on the national debt is somewhere around the tunes of $400 to $480 billion at the very current moment. If we raise the interest rate past the 1% mark, we're no longer going to be able to pay the interest on our national debt. So that's another indicator to look at for determining if the economy is going up or down, and if you want to, possibly look at investing in some of the assets out there in the stock market. Okay, because if we can't pay the interest on our national debt, chances are the economy is going to start going in a nosedive, because the problem is, to kickstart the economy, like I said, that's what the Federal Reserve does. They lower the interest rates. If they can't raise them, if they can't lower those back down, because we go into, say, a recession at 0.75 or 1%, well, they can lower it, but they're not going to be able to lower it enough to make a change or make any difference or impact in the economy to boost it back up. Okay, so that's where the problem exists there, and that's what you want to pay attention to when you're looking at this federal fund interest rate. The next one is the 10-year bond. Okay, this one is very, very, very critical and very crucial to the economy, and especially when it comes to bonds in the stock market. Okay, so like if you've got a retirement account or an IRA or something like that, you're looking for some fixed income that you want to retire on, or you have people right now who are actually retired, trying to live off this fixed income, chances are they're holding bonds, specifically the 10-year bond note. Okay, now the yield curve on this is what scares the crap out of the Federal Reserve right now, because the yield curve is falling. on the 10-year bond. What does that mean? Well, that means when you got bonds, there's a yield attached to that, or a return that the investors get back, because all a bond is U.S. debt that has to be paid back. That's why they've always been recognized as a safe haven asset, because normally we don't default on our bonds. Okay, we pay those back, and we always have throughout history. So that's what retirees are counting on as far as the retirement plans, is fixed income assets like bonds. And if this yield curve lowers to 0%, well, they're not getting any return on their money. Okay, the price of bonds, when the yield falls, the price of bonds is going to go up. So they'll make money on the front end of the price on the bonds going up, but there's no return as far as yield on the back end if that interest rate hits 0. Right now we went from 2.5% down to 2.1% on the 10-year yield. If that goes to, say, 1% or less, people aren't making any money on their fixed income investments, and your retirees, and say the baby boomers, for instance, they're not going to be able to get any money from their assets on bonds so that they can, live a comfortable lifestyle in retirement. A lot of these people are probably going to have to go back to work, or they're going to have to look for higher yield returns, which would force them into risky investments, and they don't want to do that. And neither do you if you're watching this video. Even if you're young and you're planning on building a nest egg for retirement, you want to stay away from the risk, or the riskier assets, and go with low risk. I talk about this through asymmetrical risk reward. Again, if you don't know what that's about, subscribe to the channel, go back and watch it. If you're already a subscriber, go back and brush up on that a little bit, because I specifically talk about that when it comes to reducing your risk. Now, the 10-year bond yield curve, if it goes inverted, which means negative, and that's what a lot of the investors and the experts out there, financial analysts, are talking about, is that this thing could possibly go inverted, which means negative interest on the bond. So if that happens, you're going to have retirees who are actually having their wealth eaten up by negative interest rates on U.S. debt. Okay, what are these people what are they gonna do? Again, that price of the bond goes up. They could sell and make a profit just on the front end, but a lot of these people, if they sell, they're not going to get their return. They're not going to get their fixed income investment of, say, like $50,000 on $1 million investment year over year. They're not going to get that anymore because they sold their asset. So that passive income is gone. Then it's basically from that point on, it's up to you, what you do with that $1 million in profits from your bonds that you sold, and you better hope it lasts you a while, because once that money's gone and it runs out, because you're living on it, you're done. You're not going to have any passive income coming in off of it because you sold. So that's what retirees face when it comes to the 10-year bond right now, is watching that yield curve, and it's falling right now, which is not a good signal. Every time it's fallen like this, we've always had either a recession, 2008 type moment, or even depressions. Okay, so again, if you're looking at getting into stocks, that's something to pay attention to. Back in October of 2016, China joined the SDR. Now, I have a video on this as well, and this is more of a global issue when it comes to international trade, but it does affect the U.S. dollar, because the China joining the SDR basket, which is a special drawing right through the IMF World Bank, what it did essentially is it allowed China to gain confidence in their own currency. And I believe what they did, correct me if I'm wrong here, but they created a yuan-backed Chinese bond, and I think they're backing it by gold, because what it's doing is it's giving other countries, around the globe, a chance, excuse me, around the globe, a chance to get into a new type of bond other than U.S. dollars. So it gives people a way around the U.S. dollar as far as international trade. They can trade oil, say, through the Chinese yuan. And what this does, if people aren't using the U.S. dollar for that international trade, all those dollars have to come back to our shorelines in the form of inflation. And I've been talking about that in the last few videos as well. You can go back and watch those. So you've got that as well. Baby boomers, like I said, are retiring. And through the ERISA Act, which is the Employee Retirement Income Security Act, they're being forced to sell off their 401k investments. Okay? At the age of, I believe, anywhere between 65 and 70, they have to start selling off some of these assets in their 401k. And what that does, essentially, it creates 3 sellers to every buyer in the market. So if you got 3 buyers, or I'm sorry, if you got 3 sellers to every buyer in the market, what's that tell you? There's a sell-off that's occurring. And when you get sell-offs, the market goes down. Okay, so this is just a mathematical certainty based off demographics that the market's going to start going down. Now, how long will it go down? A lot of the experts are saying that it'll go down for the next 10 to 15 years just based off that alone. Okay? So that's another thing to watch. And then you've got the government, which will be out of cash by September 30th. Okay? Currently, right now as we speak, we only have about 130 to 150 billion dollars. I don't know what the exact number is. I'd have to go back and look at the balance sheets from the government websites, but we only have 130 to 150 billion dollars left of cash to keep the government in business, in service until September 30th. After that, the only thing that they can do is either shut down the government, or they're going to have to print up more money, more currency backed by nothing to keep this whole Ponzi scheme going, so that, just essentially kicking the can down the road. Now, is that good for investors? Absolutely not, because again, it affects your U.S. dollar. It affects the value of that dollar and the price that you're going to pay on assets, as like stocks. So if you're looking at getting into investing in the stock market right now, these are things you need to look at. You need to ask yourself, look yourself in the mirror and ask yourself, do I want to do this at this current moment? Because again, like I said earlier, I've had conversations with people just in the last week, and I keep telling them, look, there's a time to invest in stocks, and there's a time you don't want to invest in stocks. So just ask yourself, is this a time that I want to invest in stocks? And for me, the answer is no. I don't want to invest in stocks. That's why I got out, and I'm looking at other opportunities. That's why you'll see in my videos moving forward that I'm starting to focus in on and pay attention to some of the cryptocurrencies and other opportunities that might be elsewhere. Okay, so I hope this video was beneficial. Give it a like. If you like the video, give it a thumbs up. Go ahead and share it with others. And remember, guys, income is the outcome. All right.